on this episode of the Who Is This podcast, brought to you by Double R Communications and Sierra Pacific Mortgage. It's actually just me and Davis today. We did another solo episode, mainly because we got a new video camera. We were tired of the other two we were using kept messing up on us. So battery would die too fast, they'd get overheated, and just they weren't accomplishing what we wanted them to accomplish. So we got a new camera. It's a pretty nice one. We wanted to try it out with the editing and everything before we had a guest. And we also want to start doing these solo episodes, once a month or so, just kind of talking about mortgages and other random topics. So hope you enjoy. Okay, all systems are good. Hi, Davis.
I was going to say something inappropriate, but I decided not to.
What were you going to say? Tell me later.
Tell you later.
Yeah, since we are going to post this episode still.
Are we?
So I might as well.
Yeah.
I mean, give Courtney some practice editing with the new camera.
True.
So if you're listening to this, what me and Davis are doing right now is we got sick of dealing with our old cameras, and
we upgraded.
We got a nice new Sony with a cool lens, and the battery won't die, so we'll have full episodes without
and if we like it enough, we might buy another one.
Yeah, I mean, it wasn't that expensive.
Yeah.
Or we can try yours with that battery
if it exists.
If it happens.
Did some research, and
it didn't look like there was anything.
Yeah, it made it seem like that's not going to be a viable option.
I think this is definitely an upgrade, and yeah, if we need to, we can get another one and have multiple angles.
Feels a little less awkward too, like
without the camera
right in front of your face.
Yeah, it's over there in the corner. I'm trying to think where we would even. I guess we could just put one there and one over here, just different. Yeah, if we needed to. But yeah, we'll let Courtney work her magic on these and see if it's as grainy as the other ones. The other ones, when you zoomed in, it wasn't great quality, but we're upgrading, and yeah, we might as well post it. Let her work on the editing of anything, and she's gonna do all the work anyways. We might as well post it. That way she doesn't feel like she did it for nothing.
Right.
So
we recently did one of these similar type episodes not too long ago, but I think we talked about doing them every so often.
Yeah. Last time we talked about what not to do, right? Or did we talk about what not to do, or just horror stories?
Yeah,
kind of both.
Bit of everything. I mean, a lot of tangential stuff, but
yeah.
But yeah, we can talk about whatever we want. We don't have to talk about mortgages even.
Dude, that sounds great, actually.
Especially today.
Yeah.
I'm running into
having a rough day.
I just have one that's on the fritz. Luckily, we just started it. Underwriters already looked at it, and we got some things we got to work through. But
so we could talk about that a little bit in detail, because we were talking about it earlier today. In this situation, it's weird because the guy has a good credit score.
Great credit score.
And most people think, because that's generally the case, good credit score, debt to income ratio, and work history, right? Like that's generally what is looked at.
Which this guy checks all those boxes.
Mm-hmm. But the issue is his credit history, which people don't understand, because usually, generally speaking, if you have a good credit score, you have a good credit history. But that's not necessarily the case in this circumstance.
Right. This guy has one trade line.
What's a trade line?
A trade line is any sort of thing that you have financed, like a car loan, a personal loan, a credit card.
Anything being reported
to the
loan,
credit bureau. A student loan, any sort of debt. Yeah, anything that would be reported to the credit bureau.
So he only has one of those.
He's got one auto loan that he's had for 3 years, and it's the only reason he even has a credit score. He has no other closed accounts. Like he's never had anything before.
Mm-hmm.
This is the only thing he's ever had financed. So enough to get him a credit score. He's got good payment history for the last 3 years, so he has a good credit score. But this scenario happens to be a USDA loan, They look at not only the score but also the history, and I will add the variety of trade lines too. So, like you could even argue he has a good history because he's had it for 3 years, but that's the only thing he's ever had.
Yeah.
And so
there's a difference of a strong or good credit score and a strong credit history. His credit history isn't strong because it's so new and there's only one trade line. But that's hard to explain to people.
This is one of the reasons I really like Credit Karma, because Credit Karma kind of does explain that to you. Like, if I open up Credit Karma, it'll show me like what contributes to my credit score. I got to be careful too, because Credit Karma will also refer you to other lenders.
Yeah.
But yeah, it'll show you like, okay, your history contributes to your score, your balances contribute to your score, the age of your accounts, your total number of accounts. So if you only have one, that'll impact your score. Your inquiries will contribute. So there's so many different things. But where was I going with that? But yeah, so this loan happens to be a USDA loan, and the every single loan file that we do, we run it through an automated underwriting system, which is, for lack of a better word, a number cruncher. We plug everything in, and it generates findings. So there's a few different underwriting systems that we use, but all of them will either give you a approval, a denial basically, or what's called a refer,
which is like a semi-approval.
Semi-approval, you have to meet stricter guidelines. Yeah. And so in this case, this one needs an approval, and it's getting a refer. And so even though he would meet the manual underwriting guidelines, this specific loan would require an approval. There's so much that goes into this stuff,
and that's what people don't understand. And what's make our jobs difficult is there's just so much gray area that honestly nobody really wants to sit down and know about all of the gray, because it's a long conversation. I mean, there's so much that goes into different loan programs and regulations, and
every single loan is different.
And it's really just not worth going into those types of details, because usually the borrowers don't care. They will, obviously they care if they're getting approved or not, but when you start getting into that much detail, I mean, my eyes start to glaze over. Right. So it's just, the bottom line is you're not really, you don't necessarily have to understand all that stuff, but in cases like this, you kind of do have to explain a little bit further. But that's when people are like, well, but why? My credit score is good. You said my DTI was fine, but that's when we have to go into a little bit more detail of there is more to it than just those simple things.
Right. When I first started doing loans, I was handed the guidelines for each, basically each loan type. Mm-hmm. All of them I was handed physical paper guidelines. All of them were 2 inches thick.
Yeah.
Here's your FHA guidelines. Here's your USDA guidelines. Here's your conventional. Here's your VA.
Yeah.
And so it's like, again, people don't understand. And was told, take 15 minutes every day and just read these, which I did pretty diligently. Uh-huh. But talk about dry.
Oh my gosh. I tried, but I found that experience is a much better teacher. Yeah. And that, I mean, and I think as much reading as you do, you're just not going to remember it all. Right. Like, it's impossible unless you're did you watch Suits?
No.
You never watched Suits?
Never.
Suits is a pretty good series. You should watch it.
It does look good. I've never gotten into it.
Suits, and I can't remember his name, maybe Mike. I don't know. One of the main characters, he has a memory where that's why he becomes a lawyer, is because he passed the bar without ever going to law school. Well, anyways, he has everything he's ever read or seen in his entire life, he can go back and quote it exactly. So anyways, if you have one of those types of memories, then yeah, you would be a great loan originator / underwriter / I mean, honestly, you'd be able to do it all by yourself.
Yeah.
But that's why we have teams, and the great team that we have, and Liz and Kim and Stevie, and then our underwriters. And I don't think it's a huge deal that I don't know every single regulation. No loan originator does.
I was going to say,
guarantee
if
you.
an LO tells you they do, they're full of crap.
They're lying. Yeah. I had a similar, luckily they're not under contract yet, but I have someone wanting to do a VA loan. This is the one I was talking to you about yesterday. Mm-hmm. Same thing. He has a good credit score. His DTI is fine. And the one of the big benefits of VA loans is the VA will accept higher debt to income ratios. Like I've done one, I think the highest debt to income ratio I ever did, I think was a 70%, because the VA goes off of residual income, which means they don't really care about your debt. But the main thing they care about is how much money you have left over.
Right.
After you've paid all your bills every month. They want to make sure you have money to live on. So the residual income after all of your bills have been paid. So if you have someone that makes a ton of money and has a ton of debt, and, technically speaking, their DTI could be 75%, as long as, I don't know if that's true. I think there is probably a cap at some point.
Right.
But as long as they have X amount left over at the end of the month, then you're good.
That's
what
VA cares about.
Yeah, that's one of the big things about VA. And so his residual income was great. I mean, his debt to income was only like a 59 or 60%, but I was getting a refer eligible instead of an approve eligible, which again, the refer is, you can still do a loan. You're still qualified for a loan, but under stricter guidelines. And with the VA, we looked it up. When it's a refer, you have to go off of a 50% or less debt to income ratio. And I couldn't figure out why I was getting that refer. But when I dug deeper into his credit history, he didn't foreclose on a VA loan, but in 2022, he had a bunch of late payments. Ugh. and ended up doing a short sell on that house. So I think that's why I was getting the refer is what his credit history. So yeah.
Moral of the story, there's
more that goes into it than people understand.
People. Hopefully, this helps them understand. Like there's no way of knowing all the answers right away, and until we dig deeper into things.
And that's why it's always,
for the most part, like when I take an application, I can tell, like, yeah, this looks like a good file, but then you get into the weeds and yeah.
And that's why, so that when we do applications, you can do a soft pull, a soft credit pull, or a hard credit pull. Soft pulls are great, and they give you they give you the same information that as a hard pull does, but only for 2 bureaus. But anyways, the main difference as far as the strength of a pre-qualification from a soft pull or a hard pull is we can't run that AUS you were talking about on a soft pull. Yeah. We have to have a hard credit pull. So in that case, I'm guessing you probably did a soft pull and couldn't run AUS. I mean, maybe not, but I've done this before. Did a soft pull, like, oh yeah, your credit score is great, everything looks awesome, but you can't run AUS, so you don't know if you have that for sure approval or refer. And so, but you tell them you're pre-qualified because they are. I mean, that's all that it takes to get pre-qualified is a soft pull, but then get under contract, then you do the hard pull, and then you kind of can run into some other things. So I try to do a hard pull as much as I can, and just because it's needed anyways, and it's just going to give you the most complete picture. But if I have a client that is specifically says, hey, I don't want a hard pull done yet, then fine, we can do a soft pull. No big deal.
Yeah. It's fun though.
Yeah, it is. We're always, a lot of times you're always working on puzzles almost.
Exactly. Yeah. You're like an investigator figuring out, like, okay, how are we going to make this work? Mm-hmm. And how are we going to save this client money? Mm-hmm. And, what's our plan for the future for this client?
Right.
That's something you got to think about too, is it's not always about just getting them through, but we want to put them in the best position. So maybe the lowest down payment today isn't necessarily the best situation for them, or the lowest monthly payment isn't necessarily the best,
or the lowest interest rate,
or the lowest interest rate isn't the best. Like an example is we get people ask all the time, should they buy down their rate right now? I think rates are going to come down, so buying the rate down right now, in my opinion, 9 times out of 10 is probably not worth doing, because if and when rates come down, then they're going to want to refinance anyway, and the amount that they spent buying that rate down is probably more than they saved between the time they close and the time they end up refinancing.
Yeah. It all comes down to the likelihood of them wanting to refinance at some point. So yeah, you run those scenarios. I'll also say, if the seller's paying for it, yeah, absolutely buy it down.
Yeah,
if you have a credit and you can buy it down, absolutely. Just because you might as well lock in a lower payment now, because we don't know rates. They've been dangling that carrot in front of us for a year and a half, it seems like now.
I just, since we've been in here, I just got an email that my borrower's seller credit is way more than their closing costs.
Oh,
not allowed.
Gotcha.
They got a good
just more
seller
than
credit,
costs.
but our closing costs came in a lot lower than we expected. And so I'm like, I don't want to lose. So we're going to take that and buy the rate down, because otherwise it just goes right back to the seller.
Yep. That's something we can talk about too, is closing costs and seller credits, because different loan types.
I do have a meeting at 1:30.
Oh, okay.
We got plenty of time.
At the office?
Yeah.
So different loan types will allow different types of seller credits. So I'm working with a realtor right now that does a lot of works with the contractor does a lot of work with the contractor in Las Cruces. And this contractor right now is offering amazing credits. So 3% seller credit. How they're advertising it is a 3% credit for the buyer to use for their costs, plus an additional $10,000 to be used to buy the rate down.
What's the price point or the price range for those
homes?
So
about $340,000 and above, you can use that full credit.
Yeah.
If it's an FHA loan, because what people don't, and that's what that's a great thing to advertise, and that's a great deal. But what people need to understand is loan regulations may not allow them to use all of those. So for example, if one that I have under contract right now is like $299, and so the max with an FHA loan, the max seller credit is 6% of the purchase price, which comes out to being about $17,000, which their credit, if they were able to use it all, is about $20,000. So there's about $3,000 that they can't use because loan regulations don't allow it to be used towards the closing costs, because the seller can only contribute so much. But so what they just take care of it on the back end and give them like upgrades on the house or something like that for the $3,000 that they're not able to use. But if they were, so let's say she was doing a conventional loan and only putting 5% down, then she could only use 3% of that seller credit. So basically she could use that 3%, but then $10,000 that they're advertising can be used to buy the rate down actually can't buy that rate down, because they're already giving that 3% credit. So they would just get $10,000 in upgrades on the house is what they end up doing. But what people, I think it's interesting that that's a good way to advertise it like that. But what clients and borrowers need to understand is it's all looped into one, whether it's being used towards buy down or closing costs. I mean, it's all essentially costs that the borrower doesn't have to pay for because they're getting that credit. I wish loan regulations would separate it and allow them to do like 3% towards closing costs, and then they can get additional specifically for the rate buy down. That would help people out, I think, a lot. But we don't make those decisions.
What would you do in that situation if you were a conventional buyer at 5%? Would they allow like a price reduction?
I think so.
Yeah.
Yeah. But honestly, I'd be happy for getting the 3% to begin with, because that's a good credit. But if they would give me $10,000 in upgrades, like to my landscaping or something like that, that might be something that I would put it towards. The other thing is, on conventional, it depends on how much money you put down.
Right.
So 0 to 10% or 0 to 9.99%, you can only get a 3% seller credit. 10% to, is it
20.
Is it 20 or
Pretty
25?
Sure. I'm pretty sure it's 20.
One of those two, but 10 to either 20 or 25%, you can get 6%. I think it might actually be 25 actually. I think if they put 25% down, they can get a 9% credit. I think Liz looked at that for me today. I could be wrong. One of the two. But so conventional.
You want to bet on it right now?
Yeah. What do you want to bet? A monster?
A monster.
Okay. So what's the bet?
If it's 20.
How much you have to put down to get a 9%?
Yeah. You say 25, I say 20.
I think you have to put 25% down to get a 9%.
You have the
seller
advantage
credit
here because you just looked this up, but I'm gonna look up the guideline.
I'm just really want to be right on camera. I'm like 99% sure. If I'm wrong, then I'm mad at Liz because she's the one that told me.
And let's see. Oh, you right.
Thank you, Liz.
Dang it.
Liz just got me a free monster from Davis. So yeah, 20. If you put 25% down on a conventional loan, the seller can contribute a 9% seller credit, which that's crazy. That's a lot. I mean, I don't. Yeah.
The crazy thing is, it's like, if I'm a seller and the buyer's putting 25% down, I'm like, why do they need a 9% credit?
Right. I know. It's all about that negotiating.
Yeah.
But yeah, all different, because that's something that I had to call the realtor and make sure. Do you need to get that?
Sorry.
That's all right. No apology necessary. Sound like things are going good? Yeah. Might be
My borrower's offer, he put in an offer on a property, but there was already another accepted offer, so he's putting in a backup offer.
Is he only interested in that property, or do you think he'll find something else?
Crazy. This guy.
Is this the guy that came in yesterday?
Yeah, he went to 3. He was just looking for any lender to give him a loan, and he went to 3 other lenders, banks and lenders, and everyone was either busy or not there or something. So he walked into our office, like the most qualified guy ever, and was already under contract. The real estate agent allowed him to sign a contract with the assumption that he would be getting a pre-qualification letter, and then he wanted to buy another house, and like, sure.
So is he he's only under contract on one, and then that was the backup offer for the second one.
Yeah, he didn't get.
Is he just buying investment properties?
Yeah.
Nice, dude. I mean, this is pure speculation on my part, but because when he came in, I could tell that communicating was going to be hard with him. I wonder if other lenders were like, I don't want to deal with this.
Yeah.
You know what I mean?
Yeah. Really hard of hearing.
Just hard of hearing is all it is. Yeah. I could hear you talking to him from my office because you were yelling at him.
Yeah. But I just told that lady, I used to work at Verizon. That's another thing I feel like I'm pretty good at, is connecting with older people, because that was a lot of our clientele at Verizon, was teaching them how to use their phones.
That's why you're such good friends with my mom.
Yeah.
Just kidding, Mom. You're not old.
I did go to her house one time and help her set up something.
Yeah, I believe it. Oh, man.
Shout out, Julie.
Shout out, Julie. I love my mom. Multiple times she'll call me and give me suggestions for the podcast, and they're always good suggestions.
Right.
We tried to get her on. She wouldn't do it.
Yeah, I was going to say, but she won't accept our invitation.
She said maybe for Mother's Day, because then it would make sense having her on.
Yeah.
Dude, what if we did your mom doesn't even listen to the podcast, huh?
She's listened to a couple episodes.
So we could do a episode with them both on at the same time.
That would be fun.
That might be fun.
Yeah.
It might be risky too. I don't know.
How fun would it be to get them like find something they disagree on and get them to argue?
Get them going at each other for the whole episode. It probably wouldn't be too difficult to find something that they disagreed on. Oh, that's funny.
I don't know, dude.
They were raised the same, probably.
Yeah,
Yeah.
those are two ladies cut from the same cloth.
Yeah, that's true. Which we're related somewhere, right? Through the Howards, I think.
I think so.
Yeah, at some point. I mean, everybody is.
Yeah.
Well, let's think about that. Isla May. How aren't you related to Isla May?
It was married to Irvin, who is my grandpa's brother.
Okay, so that's where it is. Because Isla May is my grandpa's sister.
So we're not related.
So we're not related.
Yeah. Easy to find out, though. You can get out the app and
what is it? The Family Tree app.
my wife refuses to do that with me because she doesn't want to know how closely we're related.
Yeah, you're a little far in the relationship to be.
I'm sure we're not
double-checking.
related at all.
What if you double check?
I mean, if we are, it's 20th cousins, I'm sure.
Well, yeah. Don't look.
Yeah, we're not gonna.
Anyways, what were we talking about? What else is going on in the mortgage world, Davis? Are rates ever going to come down?
Hey, if it were up to Trump, we'd be down 300 basis points.
Yeah.
Which would put us in like the 3 and 4% again.
Which for us would be amazing, and for home buyers. So I mean,
I don't know.
I'm not a economist. I don't know.
I think it's pretty simple. Supply and demand. If your interest rates come down, the demand becomes huge because now all of a sudden you've got way more qualified buyers.
Mm-hmm.
And
why wouldn't you want a high demand though? Because that's going to drive house prices up.
If you are a consumer, you wouldn't want a high demand because
house prices
sellers are going to, it becomes a feeding frenzy again. And,
right.
And exactly what we saw in 2021 and 2020. I was looking at like average house prices. Normally, like a normal increase in value would be somewhere between like 5 and 7% per year. In those years, it was like 25% per year. So it's not sustainable,
right?
But because of the lower interest rates, that seems like that is. That is what caused it because everybody.
So is that why the Fed is not wanting rates to come down because they're not wanting the home prices to go up?
Right.
Essentially.
Yeah. Exactly.
Yeah.
Because everyone already complains, and it's warranted that the price of homes is increasing at a much faster rate than the income levels.
Right. But so I guess is that on the consumer then? Like if rates came down and prices went up, then they don't have to buy the houses at the higher prices. So if they just if there's a huge demand but they're not being sold, then maybe they would come back down.
There for sure would be a breaking point or at some point that's what sellers are going to try to find is
what can they get away with?
Where can I tip this scale?
Yeah. Something my dad always told me, or he maybe said it to me once, like back in, this was before I was even doing loans or anything, because he's been in sales, but something that's always stuck with me is something is only worth what someone's willing to pay for it. So if there's buyers that are willing to pay at those higher prices, then why wouldn't the sellers sell them for more?
I agree. I think the other scary thing about that is also what we saw these big companies do is if they're getting money so cheap,
right,
to go buy up all the inventory, and that was another reason for that inflation is they would go buy up all the inventory. And then this is a strategy. I can't remember if it was Zillow or BlackRock or whoever, but I mean, it was very smart, but it kind of makes you mad. They would go to a neighborhood and say the average price of the homes in the neighborhood were $250,000. They would buy 10 homes for $250,000 in that neighborhood, and then they would buy an 11th home for $300,000. Now all of a sudden they have a comp for all these 10 homes that they can turn around and sell and make $50,000 a piece on them. So they artificially inflated the price by doing that.
On that one house.
They overpaid for the one house. They created a comp to use for the sale of all these other houses. So it's very, ethically, I can't really agree with it, but it's very smart strategy.
Right.
But that's what they could do again if they're going to buy all these homes with cheap money. Why wouldn't they?
Right.
And that's what's this.
And again, it really, it comes down to if people are willing to pay the higher prices, then I can't hold it against a seller for wanting to sell their house for as much as they can possibly get for it. I mean, I guess there's different sides as far as ethically, but why is
I agree.
Why is it on that seller to make sure his house is affordable when if there's somebody out there that will pay a higher amount,
right?
Why is it on him to make sure housing is affordable for everybody else? You know what I mean? Like it's just it's just hard because I sympathize too for people that can't afford higher priced houses,
right?
But why is that the seller's responsibility?
Yeah.
It's a rock and a hard place, you know?
Yeah. I don't know. There's a million different ways you could think about it, but it seems like things are getting tougher and tougher, and there's got to be some reckoning.
And so then you think about, well, okay, so the government has to step in and regulate, but then you have the people on the other side saying the government already regulates too much.
I do think that there is things that they can do to prevent like these big corporations to buy.
I agree with homes. On that side of things, absolutely. Yeah. If there should be, I agree. Speaking of government regulation, that's something that's exciting that's happened recently is the trigger leads thing.
Yeah,
being illegal. So if you don't know what trigger leads are, basically, if you've ever bought a house before, and this has happened to hundreds of my clients where
every single one almost, right?
Yeah, probably, but some just don't say anything to me about it. But literally when I pull your credit to get you pre-approved for a home or for a loan, that information, the credit bureaus take that information. They say, Joe Smith is buying a house. He had his credit pulled specifically to get pre-approved for a home loan. And then the credit bureaus sell that information to, I call them bottom feeder lenders because I don't like them, but these bigger lending companies that's their business model is just buying these trigger leads and then bombarding people with phone calls.
And then bait and switching your
promising them the world, saying that they can do all this stuff, and then it never ends up being the thing. But I think that in and of itself, I mean, I don't agree with, but I can kind of understand, why. But what I really have an issue with is I've literally had lenders call my clients pretending to be the same company that I am,
right?
Or say, I know you're working with, I know you're working with Sierra Pacific Mortgage. I'm calling to continue that conversation with them. So they think that they're talking to someone that I'm working with, and then start going down the road, and then they realize, like, I've had people call me and say, hey, this lender, say, hey, I just got off the phone with Jonathan. I'm getting ready to send him my stuff, and then I'll be like, wait, who's Jonathan? You're like, well, you work with him. No, I don't. Like, they've tricked you. So anyways, the regulation is they're making they're making it illegal for that to happen.
Yeah.
Which honestly is an invasion of privacy. I had somebody, I did an application with him, and then a couple days later, he came in to sign initial disclosures with me because he wanted to do it in person. And I could tell something was bothering. Like, he just looked like he was just like staring daggers at me. Like, he was just mad. And I could just tell something was off. And then he made a comment about that. He thought it was my fault that it happened, but he said that in one day he got like 120 phone calls.
Holy crap.
And so he was upset with me, and I'm like, I'm sorry that happened, but I have no control over that. Like, I have to pull your credit, and this is what they do when that happens. But
Yeah.
so that's a big win, I think, for in the mortgage world
Right.
of making that illegal.
Yeah, for sure. It is exciting. I always try to prepare my clients, like, just so you know, when I pull your credit, you're probably going to get a bunch of phone calls.
Mm-hmm.
You can just ignore them. It's a bunch of bull crap.
Yeah.
But even still, it's annoying to have to deal
And
with.
even when you prepare them for it, I don't think they really understand
Right.
like, how bad it's really going to be. I'm trying to pull up an email because Jennifer Farrell sends out like an update for like things going on in the mortgage world. So I'm going to read that update.
Cool.
So Sierra Pacific has a program called the Sierra Plus Full Doc, which is a game changer for 1099 employees. There's no minimum 1099 history required. Meaning borrowers working as contractors and can now qualify immediately. No need to wait for a 2-year tax history. So if you're 1099, I guess you just have to have one pay stub. I don't know any more details other than that, but you don't have to have that 2-year history of 1099 income under that program.
I missed that email.
That Sierra Pacific offers.
That's awesome.
Career changers, who recently went self-employed are eligible right away.
That's crazy.
So I need to look more at that program to see, because there's obviously more regulation and what we need to verify income,
Right.
but you don't have to have a 2-year tax history anymore for underneath that program. And then she also said there were major changes to FHA appraisal requirements. Appraisers no longer need to take original comparable photos and can rely solely on MLS images. And appraisers are no longer required to take pictures of attic/crawl spaces. She said croc spaces, CRAWK. Come on, Jennifer. And appraisers are no longer required to provide extensive market trend analysis in increasing, decreasing markets. And the reason those are big changes is just the timeline for appraisers.
Yeah.
They should be able to get appraisals done faster
Yeah.
because they don't have to get that stuff. So
I wonder how many appraisers were actually taking their own comp photos.
I guarantee you they went on Zillow
Yeah.
a lot of the time. Yeah. But yeah. Thanks, Jennifer, for those market update or industry updates. Those are super helpful.
Yeah.
I remember a big one that she did was back when USDA made the manufactured home. It didn't have to be it didn't have to be a new manufactured home to get a USDA
Right.
loan anymore. That's
20
a big
years
one.
old. Yeah.
Yeah.
That's awesome. Cool. I need to wrap up because I need to go prepare for this meeting a little bit.
Okay, sounds good. Hopefully the new camera worked. I think we need to have Derek back on, and we need to have Brant back on, because those are the two that the cameras piddled out on us, and we didn't have any video for either of them.
And they're both just so good looking that we need to
they
give them another shot.
They have faces made for on camera podcasts. Well, and that's what's crazy is both of their episodes did really good with views, even without the video.
Brant's was cool because we had a lot of his artwork.
Yeah.
On like a slideshow kind of thing.
I feel bad because Derek, we couldn't do any shorts, or we just had the audio, and it still got a ton of people listen to it.
Yeah.
But so definitely need to have both of them back on so that we can create the shorts and stuff for them, because that's where a lot of the marketing comes in, is those little shorts. Those really get a lot of the views. But you have a client coming in at 1:30?
Yeah, I signed disclosures.
Oh, cool. All right, sounds good, man. Well, hopefully this test run is good and we're all set up on cameras now. So Courtney, good luck.
Hi, Courtney.
Yeah, Courtney, we appreciate you. Thanks for all that you do. Please make this podcast look good. All right.
Like Gucci.